Most people have exchanged currency at an airport or a bank. What Forex traders do is the same basic idea, except the goal is to profit from how those exchange rates move. Forex, short for foreign exchange, is simply the act of buying one currency while selling another. Every trade involves a pair. Your USD is the euro versus the US dollar. If you think the euro will strengthen against the dollar, you buy. If it does, you profit. If it falls, you take a loss. That is the core mechanic. The Forex market runs 24 hours a day, 5 days a week. It moves across 3 main sessions: Asia, London, and New York. London carries the highest volume and tends to produce the strongest price movement. New York overlaps with London for a few hours and often brings sharp reversals around major news. So what actually moves prices? 3 things drive most of the action. First, interest rates. When a central bank raises rates, that currency often becomes more attractive to global investors, and demand pushes it higher. Second, economic data. Reports like inflation figures, employment numbers, and GDP can send prices moving fast, especially when the result surprises the market. Third, sentiment. When traders feel confident, they take on risk. When fear rises, money tends to flow into safer currencies like the Japanese yen or Swiss franc. A few terms you will hear constantly. A pip is the smallest standard unit of price movement. For most pairs, that is 0.0001. A lot is the size of your trade. Beginners typically start with micro lots, which carry smaller exposure. A spread is the difference between the buy and sell price. That is effectively your entry cost on every trade. And leverage allows you to control a larger position with a smaller deposit. Leverage amplifies both gains and losses, which is why most retail traders who use it without proper risk management lose money. Only trade with capital you can genuinely afford to lose. Before you trade real money, start on a demo account. It replicates live market conditions using virtual funds. At ZenithFX.com, you can open a demo account and practice on MT4 or MT5 without any financial risk. When you are ready to build a routine, keep it simple. Focus on 1 or 2 major pairs. Check an economic calendar before each session so you are not caught off guard by a scheduled news release. Mark your key support and resistance levels. Set your stop loss and take profit before you enter, not after. The practical takeaway: your first job in Forex is not to make money. It is to avoid losing it carelessly. Build the habit of using a stop loss on every single trade and keep your position sizes consistent until you understand how the market moves.